What if I told you that some of the growth you see in the markets isn't real demand at all? It's recycling. And right now, one of the most dangerous hidden forces inflating valuations is as something called circular financing. At first glance, it looks like a booming ecosystem. Chip makers are posting strong revenues. AI companies are scaling fast. Semiconductor demand looks unstoppable. But underneath it, a growing share of this activity is starting to resemble a loop, not a market. Here's how it works. A semiconductor giant invests billions into AI infrastructure companies buying their services, their chips, or even taking equity stakes. Those same AI firms then turn around and spend that capital right back on the same semiconductor ecosystem. More chip purchases, more cloud contracts, more demand. On paper, everything looks explosive. Revenues rise, guidance improves, investors cheer. But zoom out, and you realize something uncomfortable. Money is circulating within a closed system instead of being driven by external organic demand. That's the illusion. This becomes especially dangerous in semiconductors, where capital intensity is extreme. When hyperscalers, chip designers, and AI startups start financially reinforcing each other, it creates a feedback loop where growth is partially self-funded, and markets love feedback loops until they break. Because here's the risk. If even one major player slows spending, the entire chain tightens at once. Revenue projections collapse not because demand disappeared, but because the financing cycle stopped rotating. We've seen versions of this before, in telecom during the dot-com era, in energy infrastructure cycles. Even in supplier financing loops before past credit crunches, the pattern is always the same. Revenues inflate, valuations expand. Capital becomes intertwined. Risk gets hidden. And today, semiconductors sit at the center of it. The AI narrative makes it even more powerful. Every investment feels justified because future demand will catch up. But when expectations are already priced in, circular capital flows can quietly do the heavy lifting that real demand hasn't yet delivered. That's the time bomb, not a sudden crash, but a slow realization that a portion of growth was never independent in the first place. So the real question isn't whether semiconductors are important, they absolutely are. The question is, how much of today's growth is real end-user demand, and how much is just money chasing itself in a perfectly polished loop? Because when that loop breaks, markets don't correct gently, they reprice violently.